Good morning and welcome to this Monday, October 3rd, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, it was another rough week, rough quarter, rough month. Actually, the quarter wasn't too bad when we got started back in July, but by the time we got to the midway point in August, things kind of turned back around, headed lower again. And on Friday, we saw new lows on both the S&P 500 and on the NASDAQ. Certainly not good action at all. But we are turning the page to the fourth quarter. I firmly believe we're going a lot higher in the fourth quarter. We shall see. But I've got some interesting charts I'll show you here in just a couple of minutes. But before we get into that, I'm going to go ahead and take you over to earningsbeats.com. For those of you who are new, you can go into earningsbeats.com, scroll down. We have a free newsletter. Love to have you join here. All it takes is a name, email address, hit the subscribe button. It's a 3 times a week newsletter. We feature all kinds of different things, things that are important to us: earnings gaps, relative strength, price volume, candlesticks. This morning, a seasonality chart was sent out. I'll actually show that to you in just a little while. But yeah, we try to focus on a lot of different things. Also, point out a lot of good stuff that you can use over at stockcharts.com as well. But all you do is go over to earningsbeats.com, make sure you scroll down, subscribe. We do free events from time to time as well, and we always reach out to our Earnings Beats Digest community for any free events, webinars, and things that we do. So you definitely want to be a part of that. So make sure you're signed up if you're not already. Let's see, one other announcement before I get into the action. For those of you who haven't heard yet, we're having a huge conference out in Redmond, Washington this week. It's ChartCon 2022. We've done a number of these, but this is the first one since the pandemic. So this upcoming Friday and Saturday, October 7th and 8th, it'll be a 2-day interactive virtual conference. So all the speakers, and I think there are 17 of us coming from around the globe, all of us going to Redmond, Washington, into the Stock Charts new TV studio. We're all going to meet. We're going to do these events, or this event, from there. I think it's going to be really cool. I'm very excited to see their new studio. And they are going to be unveiling it for ChartCon, which is pretty amazing in itself. I don't know that I'd want to unveil it in a big event like this, but hey, they're taking a big leap of faith there. Anyway, if you do go over to stockcharts.com/ChartCon, that is right here. That's all you have to do is go into get to where I am right now, and then just go down and take a look at what's going to be going on. They've got the schedule posted in here now for day 1 and day 2. So I will be speaking twice. I will be speaking at the end of day 1 in a market outlook panel. Dave Keller will be hosting. So I'll be joining Leslie and Mary Ellen. Of course, Mary Ellen, if you followed Market Watchers Live, when I used to host their noon flagship show at Stock Charts a couple of years ago, Mary Ellen was one of my co-hosts. So that'll be fun, getting back together and talking a little bit of market with that group. And then on day 2, you can kind of take a look at the speakers and everything that's going to be taking place. But I will also be in this Bulls versus Bears debate with a lot of friends. Of course, Aaron was my other co-host. Aaron Swenlin was my other co-host at Market Watchers Live. Greg Schnell, Julius, both very good friends of mine. We've been writing side by side over at Stock Charts for a long, long time, many years. And then I know pretty much everyone on the panel. It'd be great to get together. I mean, we haven't gotten together, and like I said, it's been pre-pandemic, so it should be a lot of fun for us. And I think it'll be a lot of great information for everyone. But tremendous speakers. I feel privileged just to be in the group that's going out there. You can see Mark Chaikin. A lot of you probably use a lot of the Chaikin indicators at Stock Charts. Mark Chaikin will have a fireside chat. That'll be part of the whole conference. Larry Williams will be there, keynote presentation. I know a lot of you really like Larry. I love Larry's work. I think he's fantastic. Martin Pring, author of several technology books, and certainly one of the most renowned technicians. He'll be there with a fireside chat. Linda Raschke, another keynote presentation. But you can go down the list. I mean, it's an absolutely tremendous list of speakers. And again, I feel privileged and honored just to be included in the group. So looking forward to heading out to Redmond later this week. Speaking of that, though, my schedule here at Earnings Beats is going to be very difficult to keep going the way we're doing it currently. Over that period from Thursday, October 6th, I'll be traveling out to Seattle on Thursday, and then I'll be traveling back on Tuesday. And the entire time that I'm out there, I'll be meeting with we'll be doing the conference, obviously, but then be meeting with a lot of the folks at Stock Charts over the weekend and early next week. So I'm not sure exactly the impact on everything we do. I would just keep all this in mind, because this next, that 5 or 6 days could be very difficult to keep up with our normal Earnings Beats tasks for everyone. Anyway, if you go down and scroll down, there's opportunities to get your tickets. You can see the price over here, $299.95. I am fairly certain that if you are a member at Stock Charts, even a 30-day free trial member, this comes down and is cut in 2/3. I want to say it's like $99 if you're a member. So if you are thinking about coming, if this is something that interests you, you'd like to get all of us together kind of talking. I mean, some of these panels are going to be a lot of fun because we're not all going to agree. And so being able to go back and forth with folks you have a lot of respect for and have a lot of knowledge, I think will be very educational and be a lot of fun for us as well. Anyhow, make sure you check that out, buy your ticket, and become a member at Stock Charts if you're not already one. Even if it's a 30-day trial just to check out the site, that will cut down your entry into this conference by $200, that fee. So anyway, check all that out. Again, it's over at stockcharts.com/ChartCon. All right, let's move on. What the heck happened on Friday to close out September? Well, it wasn't pretty, that's for sure. It got me stopped out of a lot of things. We were down near some key support levels. There were a lot of signs of a potential reversal. And as a result, I got pretty aggressive on Friday morning. And I haven't really been doing a whole lot of aggressive trading, especially since that Jackson Hole speech by Fed Chief Powell. But when you hit a major support level and you've got a lot of sentiment indicators pointing to a possible reversal, to me, that's the time to give it a shot. So early Friday morning, I personally got very aggressive and bullish, thinking we were ready to make a big push to the upside. And for about an hour, that's what we did. We had a really nice rally for about an hour. And then from about, 11 o'clock, 11:30 Eastern on, right up until the close, it was just consistent selling again, distribution. And we broke down at the close. So we've got to respect it. Price action alone isn't what I'm all about, but I do respect price action above everything else. I mean, when you get price breakdown, volume picks up, you've got to respect that. The Dow Jones Industrial Average was down another 500 points on Friday, 28,725. So we did get that first trip down through 29,000. S&P 500 closed below 3,600. So remember, that old low was 3636 from back in June. That was the intraday low. The closing low, I think, was 3666. Well, we closed on Friday at 3585. So it was we've definitely pierced that prior June low. And so where do we go from here on the S&P? Very good question. I still think the signs are there for a reversal at any time, but normally you're not going to have a low that finishes right at the close, on the low. Normally we're going to have some kind of reversal. So we do have futures up this morning, which I'll talk about. No, I can give you the numbers right now. Dow futures are up 310 this morning, S&P 35, NASDAQ up 70. That was as of about 10, 15 minutes ago, right before I started the show. So things are looking up at the open. That's normally not the way bottoms form. Anything can happen, but usually we at least get another intraday low. So we'll see what happens. The 10-year Treasury is down. That 10-year Treasury yield is down 11 basis points. Or excuse me. Let me pull that. Well, we'll look at that in just a minute. Crude oil prices up about 4.25%, up almost to $83 a barrel. So definitely seeing a little bit different action as we open up October. We'll see whether or not it continues. But we saw the NASDAQ down 161 points on Friday. That took us down below the June low. We actually closed at a new low there. Mid caps down 15 points. So down about 2/3 of 1%. Small caps down the same, about 2/3 of 1%, 7 points. But you can see lows, lower lows, small caps, pretty much equal lows on the mid caps. We continue to go down. One piece of good news on this chart is that the AD line still, I think, remain very strong. I mean, we're starting to talk about price action breaking down below prior lows from June. Look at what the AD line is from June. So a lot of this manipulation discussion that I've had and talked about, where I've shown the spreadsheets, how the QQQ has traded intraday, that's still continuing for the most part, where we're still seeing the stock market trade much better after about 11 o'clock in the morning than we do opening up and in the first, 30 to 60 minutes, maybe 90. So that's still all in play. And the way that I looked at it using the QQQ intraday and the AD line, they're very similar, because the AD line, you're rewarded by strong afternoons. And so that's what we've been seeing primarily when I've gone through a lot of this manipulation discussion that I've had. So I still think the market is setting up. Wall Street, for whatever reason, you can say what, I can show you fact that money is rotating into aggressive areas of the market off of that June low. Now we can have an argument or a debate on why that's happening. But for me, there's really only one reason why. You're not going to reposition in aggressive areas. And I'll show you the chart in just a minute. But you're not going to reposition in aggressive areas unless you believe the stock market's going higher. There's no reason to get into aggressive areas if the market is poised to drop another 10, 20%. It makes no sense whatsoever to me from a common sense perspective. But anyway, we'll look at those charts in just a minute. Real estate just completely falling apart since August. Those in the bearish camp are citing inflation, thinking that inflation is just going to keep picking up. I would just ask you this one question: why is real estate absolutely falling apart in the last 45 days? Because this is one of your hedges for inflation. I mean, it is literally straight down. It's worse. It's been underperforming the S&P 500, and the S&P 500 has been straight down. Money is rotating out of real estate even faster. Discretionary down another down about 2%, still above the June low. And by the way, real estate was up on Friday. So even though it's been down, it's horrible. That was the only sector, I believe. Materials, I think, were close to, I don't know if they were up or slightly down. But real estate was definitely the best performing sector by far on Friday. So just the last month and a half, not so much. Discretionary down, utilities all of a sudden falling apart. Utilities looked really good on a relative basis until about 2 weeks ago, and it has been straight down since. So going into October, utilities not looking very good, although at this point still we are trading above the June low. Technology, weekday down almost 2%, falling to new lows. This is a group that's got to right itself for the market to recover. I don't see the stock market. I mean, I'm definitely bullish heading into year end and into next year, but I can readily admit that we're not going much to the upside until technology turns back as well. Staples breaking down. So a defensive group there, breaking down the new lows on Friday. All right, 10-year Treasury yield. I do want to mention that at the end of this week, we will have the non-farm payrolls out. And I really think what the Fed would like to see is a miss on jobs. I think that's what the Fed wants. I think the Fed wants to see this economy showing signs of really struggling. And while we're seeing it in some areas, we're not seeing it with jobs. So that would be something to watch later this week. I think the stock market would react very positively to a very bad report. I know that sounds crazy, but I think that's what the stock market wants to. I'm almost certain that's what the stock market wants to see, so that they can feel better about the fact that the Fed is going to put the brakes on these rate hikes. And as long as the Fed believes that the economy is strong enough to continue to spur inflation, they're going to continue to raise rates. That's the signal that they're sending, at least. Anyway, 10-year Treasury yield. I'm going to talk about this just a little bit more in a second, but we are down. You can see we're 370. We were up at just over 380. So we are down. I think I said 11 basis points. It's actually down, I think, a little bit more than that now. Yeah, 13 basis points. If you look at the S&P 500, and I talk about this a lot, so I won't spend a whole lot of time, but it's been a mirror image of the 10-year Treasury yield this year for the most part. So when this has been going up, I mean, since mid-August, we broke out of this trend line, the channel that we were into the downside right here. When we broke out, we've been going straight up. Stock market's been going straight down. Now, last week we topped and we started to pull back. We haven't seen a positive reaction yet in stocks. Maybe that's this week. But I do want to point out, this is something I wrote about, sent to our members last week. I'm going to annotate this because I want you to see a couple of things here. The first being the higher yield and the lower PPO. So that's a negative divergence, which normally leads to a 50-period test and a possible PPO centerline test. We pulled back quite a bit, and actually notice the dates. We topped mid-June, and we did this. We went down, it looked like we were breaking down on the yield in early August before we reversed back up. And when the yield broke out above this downtrend line, that's when we saw the S&P 500 kind of fall apart again. Well, now where are we? We never got that 50-period test. We never got the PPO centerline test. We went up to another high. And so now we've got this continuing high and this continuing lower PPO. So we've still got this negative divergence in play. And I also wanted to highlight the candlesticks, because when I get negative or positive divergences, I like to see reversing candlesticks. So you want to see shooting stars, dojis, bearish engulfing candles, maybe dark cloud cover. If you're a candlestick fan, those are some that I would be looking at. That's kind of a doji, maybe a shooting star. Look at what we had on or last week. This is a weekly chart. So right here, we had another, off of this uptrend, we had another one of these reversing. I would call it more of a doji, where you kind of open and close similar spots, so you don't have much of a candle body. It's really an indecision candlestick, and off of an uptrend, many times that will signal a reversal. Now, you don't get a reversal until you actually take out the lows. That would be your confirmation of a reversal. So that's what we'll be looking at here as we open up this week. But reversing candles and negative divergences usually, no guarantee, usually result in a reversal. Well, if the 10-year Treasury yield comes back down, that certainly would be one reason why we could see some relief in stocks. So just wanted to point that out. I think that's a newer development. Haven't really talked about that, but I do think that could be a contributing factor to what I think we'll see a rally probably heading into earnings. The only question for me is whether or not we see one more low with futures still up. I guess maybe that's somewhat in question, but we'll see. All right. S&P 500. Well, I've already talked about it earlier, but there's, you can see the breakdown closing on the lows. Again, when you go down here, you can see here we closed. It was not a great candle, but look at the next day on June 17th. We actually went down and printed an intraday low that was slightly lower than the day before. That's normally the way you're going to see a bottom on this downtrend. Look at this low down here, not only taking out these previous lows before reversing, but also taking out these lows at the end of June, early July. Look at this low down here in May. What happens here before we rally? We go down, we take out that prior low. It would just be unusual to not have a reversing candle and just set a new low and then all of a sudden take off. Could it happen? Sure. Market can do anything it wants. I mean, here we set a low in February and looked like we were going back down here, and we never set a new low below the February low before we had a big rally. Here, I think it was pretty clear we had a reversing candlestick. That's more capitulatory. The bullish engulfing candle, that's more capitulatory. This hammer with a false breakdown, that's a capitulatory type candle. So those are pretty easy to spot. Again, the way we finished on Friday on that kind of volume, I would be surprised if we didn't at least go down and, tweak the bottom intraday, but we'll see what happens. NASDAQ 100 also closing on the low there. You can see down below 11,000. We didn't even test 11,000 back in June. We're a little bit above that, around 11,001. So NASDAQ adding to the bearishness. Now, let me show you these relative charts. And some of you have seen them plenty of times. There are a lot of you maybe that are new to the show that haven't seen them. This, I think, is one of the most telling tales, for me anyway, that this bear market is not going to last. It's just not. Yeah, we went down to another low on Friday. That's got to respect it. Again, there's nothing more important to me than price, volume. We lost support. We did it on big volume. You have to respect that. In my opinion, you have to be a little bit more cautious, or maybe a lot more cautious. But with these ratios pointing the way they are, I don't believe the selling is going to last. If you look back to the end of last year, I was talking about rotation throughout the end of November and into December. But we went to one more high. And on that high, look at the ratios. Every one I'm going to show you, there's discretionary versus staples. It was rising into that move up. See us rising, but we're way off the earlier high. QQQ versus SP, S&P 500 versus Spider. We were trying to turn around at beginning of January and trying to rise, but we were way off the earlier high. Large cap growth versus value. Turned up beginning of January, but still way off its high. Money is rotating out of aggressive areas. Large cap growth versus large cap value, same. Mid cap growth versus mid cap value, same. Small cap growth versus small cap value, same. Money is rotating out of those areas as we're setting that final high to the upside. Transports versus utilities, same. So all of the aggressive versus defensive, or growth versus value, depending on how you want to look at it, all of them were turning down while the S&P made its final high. Was price the ultimate indicator, or was it the rotation? Well, look at what happened afterwards. I'll let you be the judge. Every time we went lower, all these ratios kept going lower all the way through May. Every one of them kept going down all the way through May. Then in June, kind of similar to January, when we set that last low in June, none of our ratios went to new lows. The S&P went way below the prior low. 3,900 down to the ultimate low, 3636. That's 260 points further. Yet money began rotating into aggressive areas. Why? Every one of them went to a new high. Look at where we are right now. Another new low on the S&P. XLY, XLP looks pretty good. QQQ Spider going down the last couple of months, but still well above that earlier high or earlier low back in May. There's your growth versus value, large cap. Same thing here. And look at mid caps and small caps, by the way. Not only are they higher than they were back in May. But look at the last week or two. They're moving up while the market's going down. Money's rotating. I believe Wall Street's using this to their advantage to prepare for an advance. Until these ratios change, I'm not going to change my opinion about the market. I think the market could potentially in the short term go lower. I don't, because of the breakdown at the end of last week, but I do not believe it lasts. We've got earnings coming up. I think earnings are going to be a mixed bag. I don't think they're just going to come out and be rosy, but I do think that a lot of these stocks, when they report not so great news, watch their reactions, because if they gap down and then they come roaring back after the open, I think that'll be a pretty good sign that a lot of bottoms are in. All right. Let's talk a little bit about seasonality, because we are in the fourth quarter now. This is the first day of the fourth quarter. One group that really likes the fourth quarter, one sector, it's the financials. Look across here, October, November, and December. This is the last 20 years. So this is, going all the way back to 2002. So it was bear market plus bull market. But through it all, October, November, and December, if you add those together, 1.2% average return in October, November, and December, add them together, the XLF over the last 20 years has averaged going up 4.2% the fourth quarter of the year. And if you look at the other quarters, the first quarter, the XLF is averaged going down 0.8. Second quarter, it's average going up 1.8%. Third quarter, average going up 1.9%. So negative 1.8, 1.9, 4.2. Fourth quarter. So this is a group that definitely enjoys the fourth quarter. You can see on a percentage basis, these kind of stick out like a sore thumb versus earlier in the year, rising right into the fourth quarter. So financials, if we do go higher, this is a group that you want to at least consider. One industry group within financials, and this was the chart that I featured today on the Earnings Beats Digest, investment services, which is the DJUSSB. Look at this coming across here in the fourth quarter for the last 20 years. 6.3% average return. 6.3%, that's a good annual return. Investment services has averaged that in the fourth quarter for the last 20 years, which includes a number of bear market years. That's a pretty nice return. And you go across here, first quarter, plus 0.4%. Second quarter, plus 0.4%. Third quarter, plus 1.6%. Fourth quarter, 6.3%. Now, does that mean that investment services are guaranteed to go up 6.2% or 6.3%? No, of course not. These are just tendencies, historical tendencies. Maybe the group goes lower. Maybe the market falls apart. Maybe I'm wrong. Stock market collapses in the fourth quarter. We don't know. I always say I use technical analysis, all my technical analysis tools that I use, whether it's divergences, whether it's moving averages, whether it's trend lines, price volume, and then all of the rotational work that I do, the relative strength, intermarket relationships, looking at the bond market, all of the stuff I look at, I don't try to come up with a guarantee. I look at everything and then I'm trying to manage risk. I use technical analysis and all these different tools to manage risk. If you go back and you read anything that I wrote back in December of last year, early January this year, I promise you're going to see exactly that I was not guaranteeing that prices, anything was going to go lower, that I was managing risk back then. I did not want to be on the long side going into 2022. There was too much risk. So when I look at the stock market now and I'm calling bottoms and folks are like, well, you don't know what you're talking about. You got yields going this way, yields are going up, the inflation, blah, blah, blah. Market, semiconductors are getting hit, this market's going lower. It's fine to argue about it. But when I see all these other signs, when I see sentiment, what did I call for at the beginning of the year? If you've been an earnings beats member, you know, beginning of the year, my biggest thing was sentiment. We went through a period of strength that we've never seen in the stock market before, from March 2020 to January 2022. All the Reddit folks, Wall Street bets, everybody thinking the stock market was an ATM machine. I said back then, it's not an ATM machine. I thought that when I was first trading too, back in the mid 1980s. 1987 woke me up big time. I think probably 2022 was a big wake up call for a lot of folks that were new to trading. They had never seen a correction, barely had seen a pullback. And now they've got a bear market. And those same people who thought the market would never go down now think the market can never go up. Too many problems, too many issues. And so sentiment has completely reversed. And so now we've got sentiment on the bull side. It was way, way, way on the bear side to start this year. Way too much complacency and bullishness. Anybody who wanted to buy had already bought. They were borrowing money to put it in the stock market. Now, nobody wants to touch the market. Everybody's buying puts, hand over fist versus calls. These are signs of a bottom, not a top. So for me, when I look at it, and it really since June, I haven't done very well Well, I did okay trading up through mid-August. But since mid-August, it's not been great for me because I'm not playing by bear market rules anymore. I'm playing by bull market rules. So I'm trying to buy pullbacks. I'm not trying to sell or short sell-offs. So beginning of the year, I was fine being on the short side. I thought the market was topping, going lower. I don't believe that now. So it's just my strategy is different. So my strategy is not going to work as long as the stock market's not turning around and going back to the upside. But all of my signs and signals are still pointing to prices going back up. We'll see. You know, it's a great debate. It's going to be a fun ChartCon because I'm sure I'm going to be one of the few bulls, speaking there. So we should have some pretty lively debates. It'll be a lot of fun. And listen, you believe what you believe. I'm not trying to change anyone else's opinion. If you believe we're going lower, that's fine. You might be right. You've been right for the last 6 weeks. I was wrong. I did not see this. I mean, double bottoms do happen, but I did not think we were coming back down, and especially not going to a new low. So I was completely wrong about that. Readily admit it. But it's not changing anything the way I approach the market because my signals haven't changed. Anyway, I know we're running out of time. This is the put call ratio. I just wanted to show you this. So we are starting to roll back over. That's a good sign because normally when we roll over from levels like this, if that continues, normally if you look, that marks pretty significant bottoms. So we'll see. Here was one. Now this one only lasted, I don't know, maybe we went 100, maybe 200 points there on the S&P. I mean, it's still a nice rally, but it didn't last. These equity only put call readings, this is not my long-term go-to call. This is my short-term. I mean, if you go back, you'll see plenty of spikes back in 2007, 2008. Market kept going lower. So when I look at this is not my call that the stock market's bottomed for the long term. It's my call that the stock market could be bottoming in the short term. The long-term call is more about the rotation. Why is Wall Street moving into aggressive areas if the price is going to keep going down? That's kind of the theory behind that. And we'll see. We're going to find out in time whether it works. Hey, if all those ratios turn back over and set new lows, completely different ball game. Completely different ball game, and you will hear it from me. But as long as money is not rotating into more defensive areas, I just can't get behind this move to the downside. Just like I didn't go with the breakout at the beginning of January to the upside. It's not what my signals were telling me. I'll tell you, for the three you must see, I'm just going to show you three charts that I had that I showed back Market Vision 2022. This was back January 8th, 2022, back when we were a couple of days past the all-time high. And anybody who's there knows I was bearish. Number one, we're in a secular bull market. Secular long-term bull market. I said it during the pandemic. People thought I was crazy. We came right back up to new highs. I'm saying it again. We're in a cyclical bear market, a secular bull market. It would be the first secular bull market to only last 9 years. 80s and 90s, we went through a 20-year. 50s and 60s, 20-year secular bull market. I just think asset classes rotate big picture, super cycles. Think super cycles. And I think we're in a super cycle. And you're not going to convince me with interest rates, 10-year Treasury yield at 3.7%, that we're all of a sudden going to get this, big rotation into bonds or into commodities. I don't think that's going to be the case. I think we're still in this secular bull market, and this too shall pass. That's my feeling about it. Second chart that I showed, let me see. Well, let's look at this is a different way of looking at the equity only put call ratio. This is the 253-day moving average, not the 5-day moving average, 253-day. That's trading days. 253 trading days is a year. So it's a 1-year moving average. When it starts to turn up, when it's been going down, that means the market's getting very complacent. When it starts to turn up, look at these red arrows. What does the stock market do? Struggles. Turns up, struggles. Turns up, struggles. Right in here is just very, very choppy. It struggled, but it was a crazy period with the trade war and the pandemic. But look at where first of all, look at how low we were versus any period previously this century. That's what I was talking about. Unprecedented complacency and bullishness. And when we started moving up back in January, I said we needed to reset sentiment. Look at what sentiment's been doing. More and more puts being bought. Bring it on. And what's the market been doing? Struggling. When this ultimately tops and rolls over, we're going to have the next big leg in the stock market. All right, one last chart I'll give you. I know I'm way over today. This was the chart that I gave, just to picture that there was nothing on this chart past January 8th. I said, I had these black lines in on a blank chart. I said, we're going down to this center line of this channel, and then we're going to go back up. Well, we went down to the center line, we went up, and now we've come back down. We've got basically this double bottom. I think we're going to have a little head fake here eventually. I think it's going to look similar to what we had back. And if you remember, right at the very end, we went down in 2018, the trade war. Why? Fed Chief Powell. That was when he came out and said we were going to have 2 rate hikes in 2019. Market collapsed. Well, short term. And then we came right back up. How many rate hikes did we have in 2019? 0. What did we do in July of 2019? We lowered rates. Can't believe everything you hear out of the Fed. So I think we're going to get that same type of behavior. I think we're going to get this false breakdown. I think we're going to jump back up again. And I think the Fed, I'm not saying not going to raise again because they seem pretty darn adamant about ruining the economy. I think they're making a mistake, but hey, they seem like they want to keep doing it. But I do think that tune is going to change. And when it does, that's going to lead this next rally to the upside, or the market's going to anticipate them doing it. I think the market was already anticipating that before that Jackson Hole speech back in August. And that is when things started to turn south again. Anyway, that's it for me. Again, I apologize for going long. Just had a lot to go over. Pretty big day. We'll see what the market does. Yeah, I mean, now the NASDAQ up 19. What was it, 70 or whatever I said, futures. Tesla, by the way, they came out with their third quarter deliveries below expectations. So Tesla getting hit here. I think it's an opportunity, but I wouldn't be sticking my neck out in front of this freight train today. I'd want to see the selling begin to subside, maybe get some kind of reversal. I'm a big fan of Tesla, but have no interest on a breakdown. So I'll be watching that. But right now we got the Dow up 273, S&P up 24, NASDAQ up 19. The VIX, though, is actually up a little bit today. So market's still nervous. I think it's important that the VIX stay down below 36 to 38. We don't want the fear to ramp up above what we saw earlier this year in terms of the VIX. So I like the fact that the market goes down, the VIX stays below those prior highs. But if that breaks out, we start seeing a VIX 36, 37, then you definitely want to batten down the hatches. I just think we have to be a little careful here in the very, very near term. Because again, the way we closed yesterday, normally that's not the way we bottom. So with that, I'm going to wrap up. I'll be back tomorrow over at Stock Charts TV. So at 9 a.m., just simply go to Stock Charts TV, click on that link, and you can listen in to the next Trading Places Live. Appreciate everybody tuning in. Have a great day, everybody. Happy trading.